please welcome again on stage Chief Growth Officer from Rockaway, Samantha Bobot.
I'll go over here. I hope you all enjoyed lunch, a taste of Czech cuisine. Yeah, I guess I got my introduction. I'm with Rockaway. We're an investor and builder in this area, if you missed my welcome. I'm very excited to be joined today by David Graff from White Whale, Ruben Bronze from Flow Traders, and my fabulous teammate and the manager of our DeFi yield investment strategy, Adam Bilko. Would all of you I'd like to take a few minutes so that I don't mince words for you to introduce yourselves and your companies, and if you could let us know like the types of projects or counterparties that you interface with. Said differently, why are you here? David, can we kick off with you?
Sure. Nice to meet you, everybody. I'm David, CTO of White Whale. So White Whale is a Cosmos native team. We've been working there for many years, a long history there. We run validators, secure, I think, 8 figures in assets. We have our own layer 1 blockchain called Migaloo, and we also have our own cross-chain application. So with that, we have a lot of different interactions with different people from the ecosystem, from validators, relayers, other layer 1s, market makers, of course, because it's about liquidity. Yeah.
Great, I'll take it. Yeah, pleasure to be here today. So I'm Ruben, I sit on the market making desk at Flow Traders. Flow Traders is a multi-asset liquidity provider. We have 3 key areas of interest, equities, fixed income, and CCC pillar. That really entails currencies, cryptos, and commodities. Why we're here today is we really want to discuss and explore the ways we can navigate liquidity as a market maker and how we can work with projects within the space.
Yeah. So my name is Adam. I'm part of the Rockaway team. I'm leading our liquidity division. We provide liquidity to decentralized protocols, DEXs, lending protocols. We also helping founders actually to shape their products so it would be more suitable for institutional investors because this is usually not the case in DeFi. So yeah, looking forward for discussion.
Okay, I know we want to turn to the more exciting developments and opportunities when it comes to improving liquidity, but first I'd like us to set the stage. So maybe Ruben, you can take this one. Can you tell us sort of what do we mean by DeFi liquidity and why is it so critical to how decentralized protocols function?
I think liquidity is very important because it kind of comes down to the stage that what the market maker does. The market maker is there to facilitate trading and reduce slippage. It kind of comes down to the concept of liquidity creates liquidity. So a market maker comes into a market, a stagnant market, and really drives liquidity in the market, which then attracts institutional liquidity as well as additional retail liquidity.
David, is there anything you'd add there?
Yeah, I mean, DeFi liquidity, it's really about accessibility and availability of tokens that you can trade. And it's the heart of any economy. Nothing interest happens without liquidity, so you need deep liquidity for adoption.
Okay, Adam, maybe you can flesh out for us, what is the difference between liquidity and TradFi versus DeFi?
Yeah, I think actually when you're talking about liquidity in, I would say, traditional finance, you usually think about like how quickly I can liquidate my position, without big impact, or how quickly I can buy or sell something without big price impact. But when you are talking about liquidity in DeFi, usually you're talking also about like providing liquidity to basically smart contracts where the liquidity is locked. And without that, the DeFi wouldn't work because if you think about it, like a lot of the platforms in DeFi are basically just the intermediaries between the liquidity providers and the users. So they cannot live one without the other. And of course, the more liquidity providers you have, the less slippage you have. And of course, there are other tools how you can improve slippage. But I think this is the difference in general in the perception of liquidity in DeFi and traditional markets.
So I guess before we get into how DeFi has innovated here around bootstrapping liquidity, and I guess that's some of what you do every day, evaluating these opportunities. Ruben, maybe you can speak about it from the market maker perspective. What's the role when it comes to supporting liquidity? What might make it challenging in DeFi?
So there's really 2 ways on the DeFi side. There's the central limit order books and the AMMs. So on the central limit order books, when the market maker comes in is that we provide bid orders and offers. So the role there is really to provide a deep book. So there's really 3 key metrics we look at. It's a volume, order book depth, and BO. And that's really how traders can come in, so retail as well as institutionals, and execute their order. So that's on the central limit order book side. On the AMM side, there's really 2 aspects to it. One is just providing still liquidity, coming in and providing a certain amount of TVL. And then you can also run strategies on the taking as well as the making side. And that's really where we come in as a market maker within DeFi.
David, you guys have a kind of new approach to market making and to bringing liquidity to protocols, and certainly I've been accustomed to, I guess, supporting some projects. Can you talk a little about it, and how do you think of the role of the market maker?
Sure. So we see a couple of different challenges in the way you can make markets in a decentralized finance. And one of the issues that we see is that market making with automated market makers is not really profitable. And you also have the problem of liquidity fragmentation across different chains. So we're trying to solve this by creating some kind of liquidity movement network where you can efficiently market make different networks. And when it comes to the metrics, I think as more value comes into crypto in general, there's more interest for risk management, and you need a lot of data for this. So what I've been witnessing over the last year is more and more sophisticated data points coming up from on-chain oracles or off-chain, for example, market coverage on different chains and so on.
So when I work with, often I've been asked, like, what are the things you get asked from crypto companies that you might not get from normal startups, in terms of what do they ask their VCs? And one is always, a lot of our DeFi projects, they'll say, I need liquidity providers. And they'll say, do you know the funds that can kind of bootstrap, that can participate in some of these provisioning offers? And I've done this has been about 2 years in the making. And I'll say, who are these funds? And I've looked, and one, there's very few, because they're kind of these market neutral, elusive. They have more in common with fixed income. And I'd love to hear your take on that, Adam. But it's that it's very different from the VC mindset, the kind of funds that participate in these. It's much more of a fixed return, the risk assessment, the kind of systems that you need to build on your own, like these proprietary dashboards, are much more in the fixed income markets mold. So maybe you can speak a little about, like, what are the criteria when you evaluate these opportunities? Do you need the return to be much higher than traditional lending?
Yeah, I think, like, the thing is that, VC funds in general, they have like different mandate. So they cannot just, their investors usually expect, like, okay, you will do 10 times money, 100 times money. It's risky capital, right? So you just put money into some protocol, you invest for the operation, for the growth, but you then don't have the working capital. So usually what we have seen historically, it happened a couple of times that you actually raised money, but then you didn't have the working capital to run the DeFi, to run the DEX or lending protocol, and then you're just running around the market and looking for liquidity providers. And historically, there were definitely more of us. I think after last year, there are really not that many of us who are doing this. But yeah, like when we are actually looking at the protocol, I think it's a bit different to the VC side, because we are looking definitely more at the security, because we are in the still kind of fixed income business. So if you think about it, you have a couple positions, and if you lose one, you basically lose the whole return of the fund, for example, for a year. So actually my job usually is in the risk management business. So we are looking definitely at security audits. We have a team who is looking at the quality of the code. We are looking definitely at the team. Sometimes this is a bit problematic, because when you have unknown team, you really don't know who is behind. On the other hand, I understand the incentive why you have an unknown team, because sometimes you're operating on the edge of regulation, I would say. So you need that, but I think this is another topic. So I think there are like many criteria we are looking at. We are also looking at, like, what is the sustainability of the return we are receiving, because we don't want to be there for a week or two. Like, I think the days when people were jumping from protocol to protocol, just do the yield farming and further rewards and then move to other protocol, I think these days are gone. So I think it's much more better to work with the companies we're cooperating with for longer term. But then you need to know that there is real return, and that the return is not only driven by token subsidies, because this is simply unsustainable. So I think, yeah, it takes time, but then the liquidity is for longer, and I think also the size of the liquidity you can get from one institutional investor is much bigger.
I spy a few anons here that have crawled out in the hopes of procuring some liquidity. I'd like to move towards the challenges. So maybe, Ruben, you can kick this one off. What are the main challenges when it comes to DeFi, so market making on a DEX versus on a centralized venue?
Yeah, so I think we already touched upon 2 points. One is fragmented liquidity. So across DeFi, we see liquidity fragmented across a lot of chains. Liquidity is low across the markets. So that's a problem we're facing as well. Compared to centralized, I think it's what you touched upon, Adam, is that there is no clear regulation in regards to that sometimes, as well as on-chain. There's a lot of things you have to consider. Consensus mechanisms, think about smart contract risks we have to take into account when market making. And then it's about the risk and rewards. And that's kind of the role of the market maker as well these days, is to work with DeFi protocols on the risk and rewards mechanisms, and to see how we can optimize the risk to rewards ratio.
Yeah, I think Ruben mentioned a couple of very important points. The technology is still quite new, and the market is still quite, it's a little developed compared to the traditional markets. It's comparatively almost nothing. So it takes time to develop these risk metrics, to create a really good system to assess risk. How much liquidity do I put there, or do I ignore this protocol at all? There's so many different variables, like you said, from the consensus protocol to the execution layer, the smart contracts, the regulations, a very big point for institutions. Another thing, especially on crowded blockchains, is gas. So you have a lot of unpredictable, and do my trades get executed or not? How much do they cost me? So it's really a lot of work to do there.
Yeah, so maybe I forgot to answer the question, actually. I think what we all said is basically you required higher return that you would require in TradFi, because the risks are obviously higher, right? Because it's new technology. What we do, it's some kind of VC debt, right? Because usually you get part of the protocol in terms of tokens or equity for providing the liquidity with the underlying yield, and this is something you don't really want to exit, because it's not like healthy for anyone, dumping tokens on the market. Like, anybody can do it, but what's the point, right? So that's what I'm trying to say, work long term, but of course you need then higher return.
Yeah, which I guess, adding on to that, it feels like the challenge has been a bit of asset class schizophrenia.
Yeah.
And it's maybe the same thing as real-world asset protocols and all of this, is you're approaching investors or whoever even is managing this, and you're saying, like, we're approaching this with normal fixed income models, but we have this other risk to them that's harder to quantify, which is it's just a new space. I have to understand the project and the DeFi elements in addition to the thing I get normally, which is just how are you running like a traditional fixed income product. I guess, can you, David, maybe go into, from the white whale perspective, something like Cosmos, right, where we've heard a lot of people say that the sovereignty and the fragmentation is actually its strength, I guess, from a builder perspective. From a liquidity perspective, I'd imagine that's a challenge versus more monolithic chains like a Solana or Avalanche. How do you guys think about this?
You're totally right. I mean, Cosmos has a lot of strengths, and the sovereignty is one of them, but it brings limitations and issues. And fractured liquidity and fragmentation of applications are one of them. For example, if you want to market make on Ethereum and you find your Uniswap v3, so you can, just by LPing there, you capture the whole Ethereum market, which is huge. But on Cosmos, you can't do this. Sure, there's Osmosis, which got the biggest share right now, so you could pick that one. But if you want to capture different markets, you have to interface with new DEXs, do a risk assessment for any of those chains, and then move the liquidity around with bridges. So it's significantly more complex than one of the thick chains.
So let's go, I want us to pivot a bit to the state of liquidity today. Where do things stand? Ruben or Adam, do you guys want to kick off a bit on kind of the CeFi versus DeFi market health right now? Maybe we've heard a lot of rumblings that market makers have in droves left US exchanges. Maybe could you share a little about that?
If you look at CeFi in general, I mean, liquidity has been moving sideways. Prices have been moving sideways. But that's all across the board, right? You can look at it from a macroeconomic perspective as well. Volatility is down across the board. So now I would say it's the time to build, it's time to work with protocols on finding the ways to bootstrap liquidity internally, and then really help it out from there on out into hopefully the next bull market.
Yeah, I think actually it's healthy. I think the volumes are lower across the board, but what we actually see is that people listen more. So like, when you are in the bull market, like nobody cares, everybody is just like, yeah, let's do it. And then like, oh, let's just, spin this to other chain and this to other chain, and then people stop thinking about like, why are we doing it? Like, okay, what's the point? And I think now, because there is definitely much less investors and more scarcity for capital, then people are definitely thinking more like, where do I allocate money? So I would say only the really good quality protocols get TVL these days. And if you just, fork some protocol, like, you don't get it. So I think you really need to improve, and you really need to build something more useful with sustainable yield. And I think then you can win the market, but which wasn't the case like 2 years ago, right? Whatever you did, like any offered token subsidies, you had TVL 200 mil within like two months. Of course, this was just basically renting liquidity for like a couple of weeks because crypto crowd, it's usually just chasing yield, and they don't really care that much about sustainability of the product. So I think this is maybe the difference between the institutional investors or the institutional liquidity providers, which want to stick for longer, because it makes sense, right? I mean, when you're a liquidity provider, institutional one, you usually spend a lot of time on the due diligence and etc. And then you don't want to jump from one protocol to the other. You actually want to support the winners, and you do it because you think these guys are going to be the winners. So I think this has definitely changed, and I think this is much more healthier for the whole industry than it was like 1 or 2 years ago.
Yeah, I guess how does this environment change the calculus for both of you?
So I think from like a trading strategy perspective, you touched upon like the protocol risk, for instance. If you go into a pool beforehand, you need to do an audit, you need to do a smart contract assessment. There are so many elements to it that protocols sometimes seem to forget that liquidity providers need to go through, especially coming from one, as we're trading proprietary from our own books. It does adjust the strategies. At the same time, though, like you said as well, like protocols seem to realize the necessity for market makers and the role of market makers within the protocols and how we actually work with them to build out the protocol in essence.
I think we had a lot of big setbacks and crashes over the last 2 years, from FTX to regulations. And I think both the centralized markets and the decentralized markets are in a good direction. For example, lots of exchanges have opted for proof of reserves. The security of smart contract languages and their tools is getting better. So the technology is maturing, so that's very nice. But we're still tackling or still battling with the major problems, such as fragmented liquidity or profitability of passive market making, so automated market makers. Which, by the way, is, I think, there's an interesting trend. So we have the traditional market making, which is very active. You have very granular control about your orders, and which can be very profitable. And then you have the passive, the automated market makers, which were invented here in Web3. And they're very passive, but they're not really profitable. So now we're getting something in between, like concentrated liquidity, which is half active, half passive. And there's also interesting developments on the fragment or uniting the liquidity. That's something that we were working on. So there's a lot of exciting progress. So I'd say the markets, they are in a good direction.
Okay, well, I guess you've kind of beat me to my next question, which is going to be, like, we've done the kind of, like, take your vitamins, like, we talked about the challenges, we set the stage. I'd love to look ahead for the rest of our time. So what's your outlook on kind of market health, trading activity, and maybe what are the factors that you track? What would most affect it in the months ahead?
Mm-hmm. I think one of the most interesting things that I'm looking forward is access to asynchronous liquidity. So most of the time, you access liquidity on a single DEX, or you use a DEX aggregator on one chain. But the liquidity you access is mostly synchronous because it's just on one blockchain. What I'm looking for is, and that's something, some of the real strengths of crypto and the composability you get between the chains and on-chain, that you access liquidity from different chains all at once. So that's something. So at the end state, I believe none of us here will ever interact with a single DEX anymore, because you will most of the time get liquidity or better prices if you split the trades and re-aggregate it back. So that's something that I'm looking very much forward to, but also, making market making more, make it easier across different chains. So if you want to, for example, market make different Ethereum rollups.
Someone right here just was like, yeah, when you said that, I don't want to put you on the spot, but like, dude, you looked really excited when he just said that we're not going to interact with the DEX anymore.
No, like all of it's going to be aggregated.
Yeah, maybe if I can ask, what's the timeline for that? Like, when do you think this will happen? Because I think it's also important,
So at Whitewell we work together with TFM, for those who know, and they're building the first interchain DEX aggregator. So it doesn't route just on one chain, but it routes through the interchain, but it still doesn't split the swaps, which is, in my opinion, the next logical step for a really broad access to asynchronous liquidity. So you can access it from maybe even centralized exchanges, Ethereum. We need an interoperability protocol that connects all crypto, because only then you can securely access that. And IBC is right now leading the race, and it's going to be interesting to see how that develops. Regarding timeline, I think it will take some time, a year maybe.
Like DYDX coming to Cosmos will actually maybe put more effort on that.
Potentially,
like, increase the pressure of people actually building it faster.
Yeah, and also, the IBC connections with Polkadot and Avalanche are a step in the right direction. So I think, as when this gains traction, that a lot of more different ecosystems see the benefits of let's connect, our communities, our liquidity, our apps.
Yeah, and I think liquidity is a very important aspect to consider, and especially aggregation. I completely agree that it's a very interesting move ahead. What we shouldn't forget, though, is the regulation aspect as well. I think before, and it might be an unpopular opinion sometimes, but before real institutional liquidity is going to be brought on chain, we need clear regulations and clear guidelines in which these institutions can operate. So I think that's also, looking ahead, something very important to consider.
Yeah, I think maybe one soft plug I'll do there, because you mentioned IBC is a big catalyst, so the more cross-chain interaction that liquidity can move easily. I know we have one shift to the workshop schedule, folks. So I think we're getting off at 2, and at 2:30 we have the Tower Room. Polymer is actually doing a live demo on where they're at with their IBC SDK. And I promised to mention it here, so that was the moment. I guess, Ruben, maybe for you, could you talk a little more about that cross-chain element as someone who's looking across different ecosystems and probably often frustrated, like, why am I at this Avalanche meetup and they're saying we got to bring the same liquidity providers in, and what are you doing for us? And then you go here and it's like, we're competing too. And you're like, let's just look across all of this. Can you kind of speak to that?
Definitely, I think that's kind of what I said before, right? It's the concept of liquidity, generating liquidity. If you want to go to your point about the monolithic blockchains you were mentioning before, it's that liquidity is more prevalent there. So then, considerations such as impermanent losses are easier to calculate within your trading strategies. If you look at Cosmos in general, I mean, you guys do have a very conservative stance towards liquidity providers, which is something that we also take into account into our trading strategies as a market maker, because there are simply more elements we have to take into account, especially considering impermanent loss.
I feel like one enduring strength of this ecosystem is the belief that the tech has always been there, right? It's been ahead. It's always been built with an open source mindset. And maybe a bit of if you build it, they will come. Where do you guys fall on that from the liquidity side? Is the tech enough?
So I'm not going to make a lot of friends here, but I think the tech is not there yet. I think, but this is not a Cosmos-specific problem. I think right now, blockchain or crypto is missing some vital elements, and that is some real-world use cases. Because right now, it's all about shuffling tokens left and right, and that's not enough. So if we want to really attract the large chunks of liquidity, we need real-world assets. So if one would be able to trade, stocks, bonds, commodities with the same efficiency as you can do in centralized or in traditional markets, we would see, I believe, a huge influx of liquidity that would shadow everything we've seen so far.
What about you guys? Is the tech enough? Is there another, besides real-world intersection, something else that can really lure, whether it's traders,
Yeah, maybe.
providers? Yeah.
Yeah, maybe I'll take the opposite view. I think real-world assets. If you think about it, like why they really like, I think the TradFi markets and real-world assets. If you think about bonds and equity, I was doing that historically, so kind of know it works pretty well. Like the market is pretty efficient, right? So like when people are sometimes bringing real-world assets on chain, you are kind of thinking, okay, who is the LP? Who is going to finance that? And if I'm going to do it, what's the benefits actually? Because if the money like are on chain and they leave chain, so you are basically just taking liquidity out of crypto and financing real-world asset stuff. But the guys who are in the real world, they're already there, right? So they don't need this. They don't need to go to crypto and then to real-world assets again. They just go directly, right? So basically when you have real-world assets on chain, and I think if you look at protocols which are doing there and their TVL, it actually never lift off like significantly, right? Because yeah, I think it just like adds layer which is not needed. So I think at the point like when you will have, I would look at it from maybe other perspective, and maybe you meant it this way. I mean, then you need to have kind of everything on chain. And if you have it, then you kind of have the back office for real-world assets on chain, which I think it makes a lot of sense because it's much more efficient. You know, you don't have the execution. It's really fast. You know, you don't have to wait T+2, you know, etc. So I think at that point it makes sense. But for that you need actually regulation. You need to know that basically if you buy something on chain and something goes wrong, you have somebody to go to. You know, you can go to court. So you need to have actually the regulator to come and say, what you do, it's okay, and I take it into account, and you know, it works in normal way, and we just look at blockchain as technology, which make it more efficient. Yeah. So I think...
And I think there have been interesting developments if you look at like issuance of bonds on chain.
Yeah.
And I was looking forward, just to finish off on this note, is looking forward, there are many developments in the institutional space as well as in the crypto space, which gets us very excited because there is real-world cases for it. But yeah, maybe not real-world assets in the short term, but there's definitely utilization of the blockchain.
Yeah.
Awesome. I think I'm going to have a lightning round to close it out because these are kind of fun. So all of you will have your response. Which one happens first? Cosmos TVL surpasses Solana. Spot volumes on sexes, I don't know if that's centralized exchanges, rebound past 2021 levels, or a Bitcoin ETF is approved by the SEC. Which one do you think?
So unless it's a short ETF, I don't think the SEC will approve anything.
No, that one's dead in the dust. So we're back to the first two.
So obviously Cosmos. Cosmos surpasses Solana TVL, no question.
No, definitely. I mean, if you look at all the technical innovations happening here, I think Cosmos is the way to go, and I'm really looking forward to what this year has to offer.
I agree. I mean, with USDC, you know, coming to Cosmos and DYDX launching, then I think that will be the case. It wasn't that difficult question, by the way.
I know. I think we all nailed that response. Okay. On that note, the uplifting. Thank you all for joining us, and we're going to head out.